ECB last year initiated the monetary easing policy from after hiking in response to those strong inflationary impulses. As the economy saw lower inflation and a negative outlook for growth, the central bank's monetary policy started shifting quite rapidly, and we do expect further cuts by the ECB this year to below 2%. And the reason behind that is that even though there has been a strong German fiscal, the risks from tariffs coming from the US still remain very strong, and we do think that the central bank will be offsetting that through easier monetary policy. And then let's not forget that the ECB's policy is already starting to have a positive effect on the economy as credit growth has started to improve. And we are seeing signs of that in our trackers as the interest rate sensitive parts of the economy are now responding to lower rates. So it's certainly easing stance for ECB we think will continue further into this year. It's a very big risk factor for the European economy. The rhetoric on tariffs from the US regarding Europe has been quite aggressive. So at some point 25% tariffs, including reciprocal tariffs in the form of to offset VAT, it has been talked about. But at the same time, we have also seen, in and out in the tariff policy from the US administration. So one day tariffs are announced, the next day they are postponed. That has in itself created quite a bit of uncertainty. But we are seeing signs of laying the groundwork for negotiations with Europe, and that's, I think, going to be an important risk factor for the rest of the year, especially for exporters in Europe, which are going to be exposed if some of those tariff announcements, which are likely to happen from 2nd of April onwards, are more aggressive. But at the same time, as we talked about the ECB's monetary policy and this fiscal pivot in Europe, which is in play, can be an important offset to this negative risk, which has so far not played out. And that's again obviously just on tariffs. And on geopolitics, Russia and Ukraine situation is now moving towards a settlement, whereby we are likely to see a solution which is likely to be quite in favor of Russia. But the long-term relationship between Europe and US is certainly stressed here, especially on the defense side. But we have also seen Germany respond to that with a major fiscal program in order to rearm itself and wider Europe, which is of course connected with this fiscal impulse I spoke about earlier. But there are multiple factors in play, with some factors like fiscal and easing of monetary policy offsetting potentially the tariff risk. But a lot remains to be seen in terms of the actual numbers and the details of that implementation from the US administration. Let's start with the UK. In terms of the countries, it is obviously has had lackluster growth over the last few years. Now we are seeing a push towards deregulation. We are seeing closer relationship with Europe, given the stress between the US and European security situation, especially vis-a-vis Russia and Ukraine. So undoing some of the negative shock of Brexit, and then also the ongoing monetary policy easing from the Bank of England. So all those factors are starting to become positive for the UK. Moving on to Italy, it's less exposed to the tariff war, given it has a lower share of manufacturing, similar to the UK, and it's also benefiting from the cutting of interest rates, and then this push towards more fiscal easing and especially coming from defense side as well, which we think will help the domestic economic picture. And then if you look at France, there have been political issues there in France, and we think that may actually start to become less of a risk, given the way the different European countries are coming together as US adopts a more aggressive stance towards the whole continent. And that's where we think that France can benefit again from more fiscal easing, focus on defense. Again, France has a big defense sector, which can benefit from the ongoing trends. And let's not forget that the ECB easing, as I mentioned earlier, is also very helpful for the French economy as interest rates come down. So all in all, a number of these countries are facing positive factors against the uncertainty created by tariffs in the US. I think European equity outperformance has been driven by this change in economic momentum in the two economies. So US, as a result of this extreme uncertainty triggered by the tariff policy and their intentions, for example, have started to impact domestic business and consumer confidence. At the same time, you're also seeing in the US issues with, for example, DOGE, which is obviously this big cost-cutting program, which has been impacting sentiment as well, and then the valuations of US assets, which were pricing in an extremely positive outcome. And let's not forget the trends around MEG 7, which are not that much related to elections, but certainly showing signs of further competition and reduction in barrier to entry to these technologies. So all in all, you have seen the sentiment and outlook towards US change, but at the same time in Europe, as I mentioned, the easing of the fiscal policy, which has been very drastic and very significant, plus the ECB's ongoing easing and the valuations have been very helpful on the European side. We do think that trend has legs. Some of the sectors we have been focused on are such as defense, for example, are well placed still in Europe. Your mid caps, which are less exposed to exports, are also well placed from our perspective. We are also looking at cybersecurity, for example, as Europe moves towards self-reliance and self-dependence. So more domestically oriented sectors plus those focused on security still remain our focus themes. But overall, if you look at the range of indicators we have developed, it's US which seems to be losing momentum, not Europe.